And because our cost basis was so low, what that allowed us to do is I looked at this and I went, okay, we can pay all cash for the land, the site improvements, and the first phase of containers, and we can get this thing cash flowing without any help from the bank. And for the first time ever in the self-storage industry, there was data now. And they were able to see, oh wow, everything else is crashing. The sky is falling on real estate everywhere, but here's self-storage, and it's stable.
Max Picton, welcome to Adelaide Metcalf.
Thank you kindly, and great to be back. Just a question to the audience. Did any of you guys manage to catch our first interview together when he interviewed me on the Prime podcast?
There you go.
A couple people? Okay.
So the Prime People podcast, shameless plug, is a podcast I've been doing since 2015, actually. And I just wanted to interview people that are doing interesting things in the community and kind of shine a light on them so other people can connect with them. It's why we do these events too. If you want, you can watch the replay of that story and our conversation. But first, I want to give a little bit of background, and then I want you to get into your story. I got a call 3 years ago from a very trusted referral partner. And when I say a very trusted referral partner, I've been doing this for a little while during the peak of the market and during the shifts in the market. During the peak, there was a lot of people that were snake oil salesmen in my business selling promises on napkins that they couldn't fulfill because it was a gold rush. And I didn't want to be one of those agents. Turned away a lot of business. Mike Heddle didn't want to be one of those agents and wasn't one of those agents. Mike Seal wasn't. Neither was Rook, who's kind of the glue that connects all of us together. These are people I've worked with for over a decade, and I've seen their ethics. I've seen them walk away from money to make sure that they're building the right relationships. I got a call about this guy 3 years ago. And then a year ago, he was in my car and we were driving around southwestern Ontario. And I'm gonna give you a little preview and then we're gonna get into his story. He found a way to create storage as an investment vehicle without having to deal with fighting against the $30 to $40 million companies, which are in their own kind of class, or dealing with the zoning issues and the construction issues that a lot of the mom and pops are dealing with. Like, people that go into industries and find unique ways of doing things are the ones that I find that are always at the forefront. So Max, why don't you give a little bit of what your background is before we get into the analysis on the storage solution?
Sure, so thank you. And I'll keep it a little bit more high level. If you guys want the more in-depth view, go back and watch the podcast that we did, because we talked a lot about my background in that one. But yeah, I'm not from the real estate industry originally, and I think that's probably why my ideas are a little different, more unique. I'm a lifelong entrepreneur. I started in the bar industry, so I had a nightclub, a sports bar, and then I got tired of dealing with the drunks after a lot of years in and out, and I ended up meeting a fellow that became my mentor. He was one of the titans of the construction industry. Built, he has over $11 billion in construction under his belt. Hydroelectric dams, water treatment facility for the city of Toronto. And he called me up one day and offered to back my next project, whatever that would be. And so ended up coming back to him and saying, we're going to build a beach resort. And so we ended up developing a beach resort in Picton, BC called Barefoot Beach Resort. Yurt Village, RVs in the back. We had coffee shop, restaurant, CrossFit gym, beach stage. Brought some of that entertainment stuff forward into that one as well. And then
you realized that the drunks would come back there to sleep and you couldn't kick them out, right?
Yeah, the drunks are actually worse at a beach resort than they are in the nightclubs, because, you get the deal of
can't kick them out,
4 or 5 in the morning instead of just 2. But yeah, so, and then after that, Gord's son and I ended up starting a construction company and ran that for a number of years. And brief foray into, I was headhunted for the chairman of the board for tourism when I was doing the resort thing, and then that led into city council. So very, very varied background. Done a little bit of everything. I kind of just chased my interests, my passions. But yeah, it gives me a different perspective on how things are done, or I guess it makes me question how things are done in certain industries. And that's kind of what led to the interesting things that we've done here with modular storage.
Building relationships along the way, right?
Absolutely, yeah. No, it's important to build those relationships, and that's something I've carried forward from the bar industry. Is a lot of real estate people have come from this industry, from the hospitality industry, and that's something that just comes with the territory.
Well, I think like the Barefoot Beach Resort, you'll hear it on the podcast more in detail, but I thought it was super interesting because he looked at a piece of land that was very underutilized and worked with the natives to turn around and partner up and create something absolutely incredible. They did the deal, created it, and then wanted to move on to the next challenge, right? And looking for what are people doing or what are people not doing in an industry that's existed for a very, very long time. I guess the transition to storage, where did that actually happen?
So I kind of looked at my career and I realized that everything I was doing was long hours, 12 to 15 hour days, and very hands-on. You step away for a minute and bartenders are putting money in their pocket instead of the till, or, guys are kind of doing whatever on a job site instead of getting the work done, and different things like that. And so it's very, you had to be very present for everything. And so, like a lot of people do, looked at real estate as an opportunity to kind of create that passive income that isn't really all that passive once you get into it, but that's what you're led to believe from the outside anyways. And and so started looking at ways to get into that space. And so we had a lot that we used for storing our dump trucks and excavators with a construction company, and I just started kind of looking at the configuration and going, I wonder how many doors I could fit in here for storage. I knew storage was in demand in our region, and so I kind of slapped together a quick pro forma and took it to my accountant. And I'm like, am I out to lunch here? And he goes, yeah, you're way too conservative. And the numbers I already thought looked pretty good. And so I said, okay, well, that's all the encouragement I need. And I think I'm going to move forward with this. So that's how I decided to get into it.
So, and again, the process I think is interesting. We do a lot of commercial real estate at Prime. The people I worry about are usually the ones that show up saying, I'll take 30,000 square feet. I can't go wrong. My idea is amazing. The ones that I actually have a lot of confidence in are the ones that are more conservative on running the numbers on, can I afford this rent? What's my business model? And some of the best operators are fiscally conservative. So that was a good sign when I heard that. Second was a year ago, he hopped in my car and we drove all around. We went through Strathroy, we went to Watford, we went through London, Elgin County. Because his idea was, okay, if I have an innovative concept, I want to be able to prove the market before I just roll out and say that, we're blowing the doors off this. Now, you actually did one of these in BC first, right?
Done a couple of them in BC, and then I've consulted on a number of others.
And that consulting piece, I think, is interesting. So he spends his time, flies into Ontario, spends hours in the car with us, met my father, went down to the area where my father-in-law does business, kind of really gave him the snapshot of consumer habits, and then disappears and does a boatload more research, and then comes back to us with the entire plan built out, which we're going to dig into in a moment. I guess, what was that process like? It'd be interesting to hear BC versus Ontario, because we have very different land prices. The way that we operate from a zoning perspective is very different.
Yeah, so originally, it's actually funny because I kind of realized I had something with the model. I call it the smart storage platform. The one thing we haven't talked about that's very interesting, that probably a few people raise their eyebrows at, is we actually go from a greenfield site to a cash flowing asset in 90 days. So part of my trauma from developing the beach resort was I had to deal with 4 different levels of government. So we had Ministry of Transportation, we had Transport Canada, we had the INAC, which was basically Indian Affairs, and there's one more I'm missing there. Anyways. And we had to navigate 4 different layers of government, and it was a lot. And so I went, anything I can do to avoid dealing with government in any facet would be amazing. And then, being on the inside from the city council perspective, and I feel for anybody that's ever been there, but I've seen things come forward to the city and there isn't a hurdle in place, and then staff actually rush to try and create something, which we'd always try and squash from the council table. But it was amazing how it was almost like programmed, like, oh, that seems too, like, we should probably make sure there's a process that they now need to follow and overcomplicate things. And so my idea was really to figure out a way that could avoid all of that. And that's kind of what we did with this project.
So then, landscape of storage in Canada, give these people a snapshot. Like, who are the big players? Well, where are people competing right now?
Yeah, so let's kind of get into, I think what would be valuable would be, let's start sort of big and wide and sort of the broad overview of why storage in general, and then storage in Canada. And then we'll kind of narrow into, how we look at market selection, and then we'll get right granular and on the execution side and into what makes the smart storage platform special. And so in in Canada, or sorry, in storage in general, it is, when it really took off was just prior to 2008. Like it was a mom and pop industry. There was no big multi-billion-dollar corporations or REITs or anything like that participating. And then a company came out with third-party management. And when third-party management came out, it kind of changed everything. Now the big players could come in, they could buy assets, and they could bring in a third-party manager to operate the asset. Then what happened was 2008 hit. And for the first time ever in the self-storage industry, there was data now. And they were able to see, oh wow, everything else is crashing. The sky is falling on real estate everywhere, but here's self-storage, and it's stable. And then the same thing happened again during COVID, and COVID hits, and storage actually saw a surge, and it outperformed everything. And because we now have the data, and the big REITs had all this information, billions upon billions of dollars started flooding into this asset class. And what we saw was, major capital flowing in to develop new properties, to acquire existing properties, and the whole landscape started to shift and modernize. Roll-ups were occurring. People started, buying up as many as they could, rolling it up and compressing the cap rate and flipping it to the bigger companies. And it just changed the history and the landscape. So even back when I got into it I started developing mine in 2019. We launched in early 2020. It was around 78% still mom and pop owned. And I don't know the current numbers, but I want to say it's more like 58 to 60 right now. So you can see how quickly this is shifting. And there's a lot of modernization happening as well. Like it was a very archaic operation. Like believe it or not, there's still paper ledgers in a lot of the operators, in the rural communities.
I sold one on Exeter Road, John Cook Steel. He actually took the idea from California, built it, straight old cowboy welder. And it was totally that, like all paper. Half the people that were in there were people he's known for 50 years, right?
Yeah, and it's these mom and pop operators. I know everybody by name. They haven't increased their rates in 20 years, and they're 100% full, and they think that's a good thing. And now there's a lot of sophistication coming into the space, right? While there's still a lot, still majority mom and pop, the industry is changing, and it's not a mom and pop industry anymore because you're playing against sophisticated operators now, and whether that's occurred in your market yet or not, it's coming to your market. And whether that's an acquisition or what, you're getting sophisticated operators that are coming in. They're using special pricing. They've got data that would blow the average operator's mind, right? And so it's shifting, and you need to be more competitive. You need to be aware, and you need to be technology forward. And so that's kind of what's happening, sort of broad level. And then in Canada, we're drastically underserved versus the U.S. So in the North American market, you've got the US at roughly 8.3 to 9 square feet per capita, depending on whose information you look at. And then in Canada, we're hovering around 2.5 square feet per capita. But our usage is climbing, and we're catching up on the usage side of it. And so what you've got in Canada is the institutional money is still interested here, and they know that there's development opportunity because of how underserved we are. And so what you have is sophisticated developers and operators who have set up mega funds. So one of my strategic advisors operates a company called Bluebird Self-Storage. He's got a $500 million fund and a $200 million fund currently that he's raising capital for. And so those kind of developers and operators, like they're not raising from a room full of retail investors. They're going to sovereign wealth funds. They're going to pension plans. They're going to family offices. And those kind of allocators have minimum spend thresholds. Like if they're writing you a $50 million check, they're going to say, you're not deploying less than $10 million into a single site. And we want to know the name of that site, like Vancouver, Toronto, Montreal. We're not going to invest in Strathroy, right? We don't want to have to explain to our investors where their money's going. And so because there is those big $30, $50 million checks being written, the more sophisticated groups are developing in those primary markets. And so you're seeing a lot of big $30 to $50 million mega facilities, glass-walled, beautiful, next level tech going up. And I mean, if guys are willing to write you the checks and tell you that's the markets you're going to play in, you're going to play in those markets. Yeah. Now, taking a step down to the secondary markets and tertiary markets in Canada, what you're seeing is a little different, and it's consolidation. And so what's happening there is you've got the mid-market, well, can't call them mid-market because they're billion-dollar companies as well. We've got Storage Vault International, which is Canada's only publicly traded company. So their brands are Access Storage, Sentinel in the West. So they've kind of got two different brands depending on what side of the country you're in. You've got Mini Mall Storage, and so Mini Mall is a trust, and so I think they established in 2020, they're already up to 1.4 billion in assets under management. And what they're doing is consolidating. And so there's not a single operator in Canada that hasn't had 10 phone calls on we want to buy your facility. Will you sell us your facility, right? And so that's where I'm saying the big competition's coming in. But what this has done now is it's left development in the more rural markets very underserved. And so when we talk about 2.5 square feet per capita on a national average, you can imagine that because of all the development that's been occurring in the primary markets, the Vancouvers and Torontos and everything, that's pulling the number up. And what's keeping the number down is the underdevelopment and undersupply in the more rural markets. And so that's where we're focused. We're focused on these rural opportunities because there is no sophisticated, coordinated effort to go out and develop these markets.
Yeah, well, you can see that boots on the ground. And there's two new points I wanted to make. One was on the multifamily side, right? So I remember this happened with REITs, and when you were looking at funds that were acquiring multifamily buildings at cap rates that didn't make sense, like your average investor looks for cash flow. A lot of these guys were playing with money where they're thinking 50, 100 years out. Like they're not playing by the same rule set. Sounds very similar in storage, right? Where, they're playing with large family offices that are investing hundreds of millions of dollars into asset classes. And you look at QSRs, Grand Bend's a great market too, where you can look at the dynamics of it and think, well, I could definitely see a QSR or a commercial business succeeding here, but we always struggle with attracting nationals because they just look at the seasonality. They just look at big data. Like banks are in the risk business as our money lenders. So quite often they're literally just looking at what's the vehicle traffic count. They don't really care about the seasonality like we do or understand it. And that's where some people can have a really big impact in a market where the big money is too slow to operate, which sounds very similar to self-storage. You were recently at a summit too for self-storage. I guess, what was the summit? Where was it? And what were your biggest takeaways from that?
Yeah, so I got invited to speak on the investors panel at the Canadian Self-Storage Association Investor Forum. And so that just occurred in Whistler last week. It was great. We had a very broad spectrum on the stage. So we had, it was moderated by the president of the association, Robert Madsen. And then we had Bliss Edwards from Smart Stop Storage, who just IPO'd on the New York Stock Exchange for 810 million US, I think. I think they're currently around 1.4 billion Canadian right now. And then there was David Allen from Apple Self Storage, who operates 54 facilities in Eastern Canada. Patrick Wood, who is a broker, and then myself representing the more rural and modular developments, which was a bit of a new takeaway. So yeah, it was a great panel. We had some great conversation, and it really showed just how diverse the self-storage industry is. And, I think for a lot of years in the self-storage conventions, it's been all the big guys sitting on the stage. And again, they're taking money from family offices. So most of the room was excluded when they were talking about investment opportunities. And so I had a lot of people that really appreciated the opportunity to hear from somebody that has a more accessible product in the market, I guess.
I like the scrappy people. Ryan and I were at the Hunt Club for a private wealth event last night where like Blackstone was there. They're the biggest real estate holding company on the planet. And then they were talking a lot about the language that he's talking about. I think of our build company, we have a national impact, right? Like when you think of what you're capable to do and you're fast and you're nimble and you have a different vision and resources and execution, it shows. Do you want to dig into your kind of the actual forensic breakdown of what you're actually doing? Because I think a lot of people would appreciate what that looks like.
Yeah, absolutely. So kind of, after you look at the national level and we now see what's happening on the national level. So this is, we've probably already talked about this a little bit. Over COVID, we saw through the last two economic downturns, we saw was real estate's top performing asset class. The one that I didn't really talk about up there is, or the two actually, the effective inflation hedge. So we aren't locked into any kind of rental controls. So I could literally double my rent on my tenants every 30 days if I wanted to, and there's nothing to stop me from doing it. Not that we would, but we have that ability to do that, right? And so when you look at, the inflation running rampant for a number of years, well, we can actually keep up with that. And so we can maintain margins and we can actually grow year over year, whereas, you might get locked into something with multifamily where you don't have that opportunity. And then portfolio diversification benefits. We are a non-correlated asset class. So when other assets are struggling, sometimes when we see the big economic drivers for self-storage. So as morbid as it sounds, we're driven by what's called the 4 Ds, which is death, divorce, downsizing, and dislocation. So basically, you can imagine any time that there's economic instability, those 4 Ds get driven at a more rapid pace and people turn to storage. If they're in a bad situation, they need to downsize their home, they're not parting with their belongings, they're storing them somewhere. And, so we're there as sort of that beacon of hope for them in those times of trouble. And so we actually see strength in those downturns. So this, we did chat about most of this here. And then moving into how we analyze markets and what we look for. So I'll kind of rewind into how and why I'm in Eastern Canada now, as opposed to building more in BC. And so when I originally met Aaron Rook from R&R, I was at an investor event in Kelowna, BC for Collison Rise. And we got to chatting, and he loved my business model. And he's like, you know what? He's like, and at that time, my goal was to license the smart storage platform. So it was, pay me some money, I'll come in, I'll do all the work, I'll site design it, plan it, pro formas, order all materials, oversee construction, and hand you an operating facility, right? He's like, we'll sell that all day long back where I'm from. And then he introduced me to the CEO of a company in London, and within 3 days of meeting him, I should say, guy is a mover and shaker. But anyways, within 3 days of meeting him, I had that, and I'm going through and I'm doing the pro forma, and I got to the land cost. And I'm from BC, right? Like, we're mountains, lakes, try and find flat level developable land. You're $1.5–2 million an acre to start if you can find it. And I got to the land costs for this property, and it said $300,000, and I'm looking at it and I'm like, can't be right. And I actually called the guy and I'm like, so can I just confirm, like, you're missing a zero, right? Like, that's supposed to be 3 million. He goes, what are you talking about? He's like, no, that's 300,000. I was like, and the rental rates were higher here, which just blew my mind. And as soon as I saw that, I said, okay, we don't want to license this here anymore. We need to come out here and we need to look at developing out here. Because at the end of the day, when you're a developer, nobody cares what you paid for the land. They care about the free cash flow of the asset, the net operating income, NOI is what we call it in the industry. And so the NOI drives the value of your facility. And so I'm like, okay, well, I can develop the same product out here in this market. It will be worth more, and I'll pay 25% of the land costs. And so, that's when I flew out and you and I met.
Yeah, and I mean, our goal, like going back to our conversation earlier I had with Heddle, is when we get a mandate, we're trying to think of the problems the client has before the client actually has them. And like, the landscape of our territory is very unique. You really need to know what a location like this is in terms of a link to the north end, all the way to the 402 to the 401, proximity to Detroit Airport, because a lot of people are going to fly internationally. It's way easier to go through that airport. Same thing with his locations. He's like, hub and spoke model, where are the underserved areas? And what I thought was super interesting was the board of advisors that I've met over the years that he's plugged into are people that are just black belts at what they do. Like, he never really got over his skis in terms of thinking, okay, well, I'm going to go up against Bluebird and figure out how they're doing it. He literally hired the guy that does site acquisitions for Bluebird, because he's kind of non-competitive because it's a different environment in the sub 20 or $30 million range than the other side. So I thought that was an interesting take. The GLA, I tagged this. This is me, trademark, Greater London area. I'm kidding, but we are kind of becoming like the GTA. Like, if you look within an hour's drive, Byron used to be separate from London. Well, Byron's definitely part of London now. What's going to happen with Arva, and then how far is it going to go to Lucan? And then we're looking at both lakes, Lake Erie to Lake Huron. You go Grand Bend to Port Stanley, everything in between. I think as a test market, a lot of people don't know this, we are actually a national test market. When Wendy's launched their new concept for their store design, they did it in London first, because we're so far removed from Toronto that we're not going to Toronto to buy a quick pair of shoes. It's a very different dynamic, right? So identified London, and then he's like, what about St. Thomas? And now looking at the different areas, you want to talk a little bit about the population versus storage development?
Yeah, so when we look at the market first and foremost, we want to know that there's development opportunity for multiple assets in the area, right? You want the operational hub and spoke for the efficiency of the model, because the more efficiently you can operate the assets, the more free cash flow, the more the asset is valued at the end of the day. And so, we looked and we saw that the greater London area was great for that. There was multiple different markets that we could look at. And so then the next thing we look at is we look at migration trends. And so particularly because of COVID, and actually starting a little bit before COVID, actually, there was a lot of migration into the greater London area. And so you can see that growth curve there and the climb of the population. And then the next thing we do is we look at the development, and the development is basically flatlined. So you've got a massive increase in population, but no new supply coming online to serve that population. So that then indicates an opportunity. We then look at the delta between the land costs and the rental rates, and we go, okay, this is starting to look very promising. And then the one thing that we do then that's a little bit different, and again, because we're looking at regions as opposed to individual locations, is most people when they do a feasibility study, as most of the room probably knows, you go and you say, here's an address, and please tell me if my project is viable at this address. And we went in, I said, I went to the Canadian Self-Storage Valuation Services. They're the best of the best when it comes to these feasibility studies. And we said, okay, here's the region that we're interested in developing in. I want the 30,000 foot overview. Tell me how much residual demand is there in each one of these markets. So then we know exactly how much storage we can develop in each one of them. And so I can tell you that the City of London has room for an additional 75 to 275,000 net rentable square feet of development. Woodstock is overbuilt by 80,000, so we're not interested in Woodstock. St. Thomas has room for 49 to 64,000 net rentable square feet. And so when you know the residual demand, this is pent up demand. These are people that if there was storage available today would be buying it, but they just don't have that availability. And so once we know that number, I know that with our development model, we can achieve a 45% site coverage. And so at 45% site coverage, that's roughly 20,000 net rentable square feet per acre. And so in a market like St. Thomas, we've now talked with Prime and said, please go and find us the best 3-acre sites in St. Thomas. And then here's our criteria. And and so it's a very analytical approach on how you find the right market, and then getting into it, how you find the right site.
I tried to get Mr. Elgin County to run for mayor. Grant would make a great mayor of St. Thomas. Because while we're looking for sites too, is just literally saying, hey, if you know anybody that has lands on major artery roads, we'd love to look at those potential sites on the acquisition side, because a lot of it's going to happen broker to broker, person to person. It's a relationship driven business, right? Now that he's identified those sites, we have that mandate where we're going out and we're doing the acquisitions, and they're being pretty forensic on how they're analyzing them. What I thought was super interesting though is the financing side. So you talk about equity first financing versus going to a bank. Can maybe break this down in like a language for a fifth grader of what that means, right?
Yeah, so maybe before we jump into that specifically, I'll just kind of give more of a broad overview on our development model, because we haven't really touched on what makes the development model unique, which then allows for the equity first financing. So when we created the smart storage platform, the whole reason that came about is I was looking for asymmetrical risk, right? Like trying to mitigate downside. So obviously with my mentor being one of the largest construction guys in the country, we could have built anything. But what I didn't know was how to build the right product mix for our market. And I didn't want to build some big facility and end up with a whole bunch of unused units because I built 10 by 20s and the market wanted 10 by 10s. So we started looking for ways to mitigate that risk. And that's when I ended up coming across a product called Boxwell. And Boxwell...
Do you have a photo of it in the slide deck?
There is, yeah. I'm not sure how far ahead, but you can click through.
There you go.
So these are the facilities that we develop. And as you can see, it looks very much like any other typical drive-up facility. But what these are actually purpose-built modular storage units specifically for the storage industry. They can be configured with multiple different door configurations, 1 door, 2 door, 3 door, 4 doors. And so what I was able to do is I was able to then use my best estimate for product mix, because I couldn't call my competitors and say, hey, what should I build to compete with you? And so I could use my best estimate on the product mix, and then I could do that for, a third or 50% of the site, and then I could tailor the rest of the developments like directly to consumer demand. So we could see exactly what was renting, and then we could maximize occupancy by building just more of what the market wanted.
It's like a SaaS product, right? If I'm rolling out an app, people could think, oh, I got a genius idea. I'm going to build the entire app and then give it to the consumer. what I've actually learned is they wireframe it first. They'll literally draw it on paper, go to a mall and talk to people and be like, would you use this? And quite often people will use that asset very differently than you thought they would. So for example, if we're going after like a 3-acre site, you're talking about taking like the first acre and figuring out what the consumers want before you do anything on 2 or 3, right?
Exactly. And so, and that allows it, that really mitigates the risk for us too, because if for whatever reason, the feasibility studies were wrong, the market research was off, the market softens for whatever reason, we're not committed to building out the rest of the site. We can just stop development there. So, it really creates this great asymmetrical risk profile for us. And then as we see that the market, like, so the first one, the one in the bottom right there, we actually hit 100% occupancy in 40 days. So that was a very strong market because we did the research, we did the homework, and we knew we could fill that up. And so, then we were able to fast track the rest of the development and, had a stabilized asset in 18 months. And so, so that's sort of the phase development. Also, the other thing that I did differently, and so back in 2019, like I told you, this was largely a mom and pop industry, and it was an overlooked asset class, and there hadn't been a lot of technological advancement that had happened in it. And at the time, I was like, well, there's got to be some sort of automation tools. Like, I don't want to sit behind a desk for 8 hours a day just waiting for somebody to walk through. Like, I'm a people person.
You look overdressed to work in a storage facility.
Yeah, and so so I started looking for a system, and there was no cohesive system on the market to actually address this issue. And so I set about just kind of piecing together my own. I found a smart lock system that just launched into the marketplace. I was such an early adopter to it that we actually had to get them to build the original APIs with the software company that we wanted to use, set up a call center, integrate all that. And I didn't realize at the time, but that was actually Canada's very first fully automated unmanned facility that ran through technology. We learned that when, a year and a half later at the first storage convention when everybody was blown away by what we had put together. And so that then allows us also much greater margins. So a traditional manned facility runs at 60 to 70% profit margins, which is fantastic because any business operator knows if you got those kind of margins, you're doing well. We actually achieve 80+% profit margins because we've eliminated the human capital side of things. So that kind of, gives another bit of competitive advantage and creates more asymmetrical risk. And then the other side is we have fixed cost contracts. So we don't have fluctuations in our building costs like a lot of other builders do, right? In a traditional development, you've got, in storage anyways, you're anywhere from 24 to 48 months for development, depending on the size and scale of it. A year, that's permitting, then you've got, foundations and this, and a lot can happen to your supply chain during that time, right? And so if if you've projected numbers based on certain construction costs, and by the time you actually get to the project, tariffs have come in and steel prices gone through the roof and whatever else has happened in the world's economy, you're stuck. Well, we can develop a site in 90 days, and we have fixed price agreements on all of our supply chain. And so we actually have a lot of certainty when we go to roll out a development. We're not dealing with the same fluctuations that a lot of the other developers are. And so that's another benefit of modular angle.
And it's because everything's purchased, ready to go. And on the permitting side, why it doesn't take you 36 or 48 months to build these facilities. Can you explain that?
Yeah, so I mean, typically you'd have to, you find a site, you look at all the zoning, you'd meet with the city, present plans, you have to obtain the permits and all that to go and start with building your foundations and yada yada yada, like the traditional developer program. And with our product, because we're not actually permanently affixing anything to the ground, so those images that you guys saw in the photos there, like those are just placed onto the ground. So we build these containers. It takes about 20 minutes to assemble each container, and then we just place it on the ground, and we build the next one, place it next to it. And so we come in, we grade the site, we level it. We then use recycled asphalt product for our surfacing material. And the reason that we do that is because it's porous and it still allows the rainwater to soak through. But because it's recycled asphalt, it still has the tar content in it. And so it actually sets up very firm and nice and completely dust-free. So it's as easy to work with as gravel, but it's got the benefits of asphalt. But because you're permeable, you don't have to get into expensive water management plans. And again, no permits. And so, a lot of this is, come from my background in the construction side of things. We know how to do things, keep it above board.
Sure.
And then on the city side, I know about the permitting side, and I know that, rules can be made to stand in your way if you have to ask permission. So we do everything above the board. We just know the rules well enough. We go in, we find sites that are already storage as an allowable use. And so, as you know, we had, one of our team members is a land planning engineer. He produces the report for us on the market that we go into. He says, here's the zones that you can go into and you can build this without asking any questions. You don't need to talk to anybody at the city. You're good to go on this. And so we take that, we hand that to our brokerage team, and then they can find the sites that already meet the demand. So now we can go in, we've then assembled these containers, place them down, and we've got a cash flowing facility in 90 days.
So high level, zooming out for a quick second, one reason why I like being like people like Max here and going through detailed adaptations to the market is it's an indication on how innovation is really what allows people to see where the market is. You have to create your own market. So many people are just going on MLS looking for opportunities. They don't exist. I can tell you that right now. You're not going to find a cash flowing, even multifamily. You're going to have to find something that's underperforming and then reposition it. Like sitting in this house, I'm thinking about, people will see a house like this listed. It's absolutely incredible. The facility is absolutely wild. The right person will look at it as, oh, I could literally create a multi-million-dollar YouTube channel with a facility like this. I'd be able to stream 2 or 3 days a week. I'd be able to sell courses. I could literally turn this into a profit center. Max, what I thought was interesting when I met him was I know people that own storage. I've sold facilities for people that own a lot of it's old money. And again, the mom and pop kind of outfits. And I know some of the big boys that do what they do. There's just zero innovation. And I thought it was so interesting when he's like, yeah, we're looking for a site. As long as zoning's approved, I don't even have to go in for a permit. And I'm like, what are you talking about? Like, you have to go through the process. It's like, no, this is how we do it. Like, found a material that will qualify as a fantastic base. Here's how we flat pack these modular storage solutions. And then this is how we're not going to get over our skis. On the financing side too, when he was talking about equity financing.
Oh yeah, we didn't actually do
the reason I was like prompting him on that is like, man, banks make a lot of money off us, right? Like we are looking for ways on doing more with less. Like I said earlier, Damien, that you wrote down in your notebook. Shout out. That piece, how do you get the banks out of the pro forma?
Yeah, so the great thing, like I said, like we're building in the secondary, tertiary markets of Canada. This model does not work in downtown Toronto, so don't go and buy a piece of dirt over there and tell me that this isn't feasible. That's not what we're trying to do. We know this is a rural market play, and so we're going in, and land cost is reasonable. Like I said, $300 to $500 an acre is the cost in these kind of submarkets, and because of the container model and because of how efficiently we're able to develop these products, I'm $63 a square foot to do a development after the land purchase. Our competitors would be $120 to $150 a square foot. So it's a lot more expensive to build a traditional self-storage facility than to build our model. And so because we've got that lower cost basis, and because we are doing the phased approach and we're not building the entire facility at the onset, it gave us the ability to be creative with the financing. So we took a look at the macro picture of what was happening in real estate in Canada, and we've all heard the horror stories, and I hope none of you in the audience have had to experience it, what's happened with the condo market in Toronto, and a lot of investors left holding the bag. And I said, okay, well, we can't come to the market with another deal that looks exactly like all the other ones that have been not performing all that well, especially with a new vision on how to implement this and whatever else. And so we looked at how can we get creative with the way these things are financed and developed. And because our cost basis was so low, what that allowed us to do is I looked at this and I went, okay, we can pay all cash for the land, the site improvements, and the first phase of containers, and we can get this thing cash flowing without any help from the bank. Then, and only then, once it's cash flowing and it's already de-risked and we're seeing the lease up doing what it's supposed to do, then and only then do we go to the bank and we say, okay, let's get very conservative leverage to develop phase 2. And as long as phase 2 is then performing as we expect, then we go in back to the bank and we say phase 3. And at no point in time do we ever exceed 50% loan to invested capital. So we are extremely, extremely conservative. Like I'm the most risk adverse person, and this is the first time that like I've always done deals with me and my partners, and we've always invested our capital and built things. This is the first time that we're going for outside capital to do a development. You know, we've done these before, we know that they work, but now it's somebody else's money that we're using, and so I'm on a whole nother level of risk mitigation in here. And so, you know, for me to sleep well at night, we've got to put layer upon layer upon layer of protections into these deals. And that was the best way to do that. And so,
And then expansion plans, you said 30 to 50 facilities in the next 5 years. That, you know, I think of this room and I'm like, this is 10 years in the making. Everybody that's here in different relationships and capacities, him sitting here, us, and the business we've done over the years. I know you've been planning this since you said 2019. So now, is it now time that you're going to actually execute and roll out?
yeah, it's been a long time in planning phase. We've had a lot of, you know, learnings along the way. You know, originally we were going to be aggressive and we were going to do it through a mutual fund trust, and we had things that didn't work out with outside partners and different reasons why we've pivoted and zigged and zagged and weaved, and ended up deciding that, you know what, we're going to keep it all in our control. And so we shrank it down, and we're starting with a single property and rolling out. But our vision is large, right? Like I see this opportunity. There is no sophisticated, coordinated effort to develop in the secondary, tertiary markets. Through my conversations with Reed, so I briefly mentioned him earlier. He's the founder of Bluebird Self Storage and Sunbird Self Storage. He's got 2.1 million square feet under development in Canada, another 1.2 million square feet under development in the US. He's the most prolific developer of self-storage in the history of the asset class. Like him and his partners have developed almost 150 Class A facilities at, you know, $30 to $50 million per facility. So we're talking major developer. And so, you know, I have these conversations with him, and he agreed to come on and advise us because he can't develop in these markets. Like they cannot. And so he said, you're looking at the right markets in the right time. You've got a very interesting business model. He's like, you've got a 5 to 7 year window in Canada where nobody's going to be competing with you because there's still so much room in the primary markets. We're starting to see that shift in the US, where the primary markets are becoming saturated enough that the big guys are getting forced into the smaller markets. And so there's no room for the capital in the major markets. And so he's like, what that tells me is, yeah, you've got a runway here. And so he's like, go for it. And so, you know, when we looked at that, we said, okay, if we're going to capitalize on this, it is the right time to go and start talking to outside investors to achieve that vision.
And no drunk people in your storage net.
No drunk people.
Yeah, I love it. I love, like I said, scrappy people that are willing to do things a little bit differently. And also what he said earlier, you know, going through that time frame, learning from things that you feel painful at the time end up leading you to opportunities you didn't even know were there, right? So again, I create these opportunities for people to make connections. So if you would like to connect with Max directly, feel free. I think what they're doing in the storage space is super innovative. We'll be probably putting out some content, and you'll probably see me on Instagram running around piles of dirt looking for sites for him as well. So I appreciate the time, Max. Thanks for coming.